Okay, so last class we left off on return on equity. And just to refresh your memory, this is basically the money you put into a business and your return on it. For example, if you bought a house but only put $5,000 down and the house generated $5,000 in rental income or profits, then you have 100% return on equity. However, if you put $100,000 of your cash into a house and it only had a $5,000 profit, it'd only be a 5% return on equity. So it's a relationship of sort of measuring the return on the actual money you put into the business, not the total return of the business. Now, the thing that makes this tricky is that if the smaller amount of money you put down, and the more that you borrow, it's going to increase your return on equity. But that also shows the company's more risky if you borrowed more money. So there's sort of you got to look into this number a little bit more closely. The best reading for this number would be a company where there's a high percentage of equity and a high return on equity. That would be the best situation. So if you had a return on equity, say 40%, the best situation for that 40% to be in is if you fully own the company, a company's 100% equity, no debt. If you have a 40% return on equity and the company's you only own 5% of the company, that's not as strong because the leverage will make the return on equity much higher. So if you're looking at compared to companies, you don't necessarily pick the company that has the highest return on equity. You pick the company, you want to make it proportional to the amount of equity within the company, because a small amount of equity will make this percentage very high on the same amount of profit. So you have to kind of interpret it. You can't just look at the number and say it's higher, it's better. If both companies have equal equity positions, then higher would be better. But they're not always equal, so that's why you have to kind of take that in mind. So it's one of the ratios you can't just look at and say, comparing between companies. If it's the same company over time and the return on equity is increasing, generally you could say, okay, they're doing better, especially if their equity isn't changing. If their equity is actually increasing and return on equity is increasing, that's phenomenal if they're doing that. So this usually requires a little bit more interpretation before you would buy or sell a company based on return on equity. Return on assets is looking at the assets a company has and then the return you get on them. It's specifically related to net profit margin, which is the most true return. So again, I use the example of if you have ice cream shops, one that has very low amount of assets, they just have refrigerators and ice cream scoops, and then you have the high-tech ice cream shop with all those soft serve ice cream machines that cost a lot of money. They could be up to 50, 100,000 for some of those soft serve machines. If you look at a Red Mango, they'll have like a bank of 4 or 5 of them. That's going to be a lot more assets you need to open up a Red Mango than you would to open up, say, a Baskin & Robbins, which is just really scooped ice cream, or even Haagen-Dazs, which is just scooped ice cream. So if both companies have the same profits, the company with the lower amount of assets is going to have a higher return on assets. And as investors, we want companies to use the assets as most effectively as possible. So if you had when you played the Zoom simulation in the finance class, when your business expanded, you bought new factories. But if there was an option, it cost you $10 million to buy a new factory to expand to make 1,000 more cars. It would have, if there was, I guess the simulation assumed those were 24-hour factories. If those factories were only, you bought the factory and 1,000 cars were only for 12 hours, and they had an option where, for not 10 million, but for 500,000, you could add a second shift. That would be a lot more effective use of those assets. You could run those 24 hours a day. Even if you look at some restaurants, some businesses, if they could run the business 24 hours a day and still have customers, then their return on assets have gone up. In fact, McDonald's a few years ago made a push to make more of its stores 24 hours. And there are even the two McDonald's closest to where we are the one on the Wisconsin Highway and on sort of like near Stony Brook Road, Wisconsin Highway. That's 24 hours. The one on Middle Country Road near Nichols and Middle Country, that's 24 hours. And McDonald's pushed their restaurants to be 24 hours because they're open, they're staffing it from 5 a.m. to 1 a.m. anyway. So what's an extra 4.5 hours to be open if it results in selling X amount of more sales the whole year? The asset is that restaurant, that building, all the equipment in it. So if you just pay for some salaries, and sometimes you only need a crew of 3 people to run those 4 hours. And whatever extra money they're generating is more effective use of those assets. And indeed, the return on assets went up for those stores for having them 24 hours. Hopefully, you're in an area where you can support 24 hours. Not every location, the population density is an important thing as far as retail. And that's why, of course, if you notice the push for stores to be open during Thanksgiving, this is something virtually unheard of 10 years ago. No store was open on Thanksgiving or Thanksgiving night. They opened up Friday. Or even 5 years ago, they would open up early, like 1 a.m. Friday morning, like 1 hour after Thanksgiving closed, was ended. And now they're extending that into starting opening on Thanksgiving night, even opening Thanksgiving afternoon to generate more revenue on their assets. So, and it's why a lot of airline industries will fly their planes as continuously as possible and make these routes where it just goes one airport to the next, to the next, to the next, and back, so making a circle around the country because they want to keep that flight, if it's an airline, they probably want to keep that plane in the air from 6 in the morning to midnight at night. Most airports will close, not all, but a lot will close at midnight, like a MacArthur Regional Airport. But the idea is get as much money out of your assets as possible. And think of it this way. Say you had a machine that would spit out golden coins. Would you just turn that machine off, only turn it on 8 hours a day, or would you let that machine run 24 hours a day? Yeah, think it's like an ATM machine. It's a magical ATM machine, and every minute it spits out a $20 bill. Would you turn that off after 8 hours, or would you let that run the whole day, continuously? Yes. Well, okay, maybe from 1 a.m. to 5 a.m., it only spits out $10 bills, so half the amount of money. I guess I'll shut it off then. If it's making money above what our costs are, why would we turn it off? I would understand that if it was only spitting out $1 bills at that point, but costing us $2 in electric to run it, then we would shut it off. So you have to do the analysis to see when is the asset generating us money and when is it not. So if there's a point where the asset won't generate us money, or if there's a point where we're going to break the asset by overusing it, by not giving it a rest or a repair or service, that all has to be factored in the corporate analysis of how you utilize that asset. How can we push it to the limit without breaking it? And some assets can just run continuously without ever needing any repair time. But as business managers, as businesses, we have to think, the assets for the company, how can we extend them to make the most from them? And the more I can get out of my assets, and sometimes it could be, just better software that makes the asset run better. Maybe it's computer assets or banks of computers. And so instead of purchasing new computing power, just like at home, you have a PC, and instead of buying a whole new PC, maybe you just need to install a little bit more RAM in that, or a better power supply or something to keep it running. So sometimes it could be just the fact that you're not replacing assets with more expensive assets, you're keeping your existing assets working longer. Okay, so if we want to take a breakdown, if the return on equity is actually going to be what they call return on assets times the equity multiplier. And the equity multiplier is total assets divided by total stockholders' equity. So it's giving us a percentage of how our assets relate to our equity. So this would really be what percentage of our assets are financed by equity. And we multiply that by return on assets, and we get a return on equity, because those formulas are related because they're using the same inputs. So if our return on equity is moving higher, Is it because of how much debt we have, or is it because of how the firm manages the assets? And this is what tells us that. Because remember I said earlier, return on equity needs a little bit more analysis for debt. If we're using debt, if we're taking on too much debt. So this will give us an idea, the equity multiplier will give us an idea of whether this return on equity is being financed by debt, or is it because the management's using its assets and operations more effectively. And that's what we want. We don't want to fuel the growth and return equity by taking on more debt and shrinking the amount of equity in relationship. We want to make sure. So that's why we sometimes will have an additional breakdown to really get at that issue. Did they grow their equity? It's sort of like in your stock account, they certainly let you borrow 200% of your cash and you go and buy a bunch more stock, you're going to have, you may be fueling your return on equity based on your more highly leveraged position. Wouldn't it be better if you fueled your return on equity by the success of your stock picks rather than buying more stock and going into more debt? Okay. Now, in common stock ratios, these are things that are measuring not really the company per se, but more utilizing the position of stock. And PE is one of the most important ratios to look at. Price to earnings, sometimes called the price multiple, but the PE ratio is one of the ratios that are most talked about, most looked at, and it's just looking at the net price of the stock divided by the earnings per share. It's a multiple of earnings, what they might call. So if a stock makes $5 per share earnings and it's trading at $10, the PE is very low at 2. And we would say that's sort of less expensive or undervalued, because most stocks will trade at a PE of at least 10. So that should be a $5 earnings per share, should be a $50 per share stock. In some areas, it's common for the PE to be 20. Maybe in the software area, it's common for price to earnings to be 20. So a $5 earnings per share should result in a $100 stock. So this way, we have this relationship, specifically by industry, where we can understand that if a company's going to say, we're going to put an extra dollar per earnings on our stock, that should translate in your mind to be, okay, then that means the stock price should go up an extra $20 if it's a 20 point multiple. So $1 of extra earnings per share equals $20 or more stock price. So that's why companies are so sensitive when they release earnings, that the stock price moves so violently to earnings changes. So an additional surprise of $1 earnings will probably shoot the stock up in the software industry an extra $20. But if they disappoint, they said we're going to have $4 earnings per share, but they really come out with 3, then the stock will probably go down 20 or more as punishment for the upsetting them. So the PE multiple, if we're looking at all the software companies, you line up all the software companies' PE multiples, the ones at the higher end would be considered more expensive, and the PE multiples at the lower numbers would be considered less expensive. But remember, you get what you pay for. You ever hear that expression? You get what you pay for? You know what that means? If you buy something cheap and inexpensive, you're going to get not as good of a product than if you buy something that's more expensive. For example, you can go to the dollar store and buy yourself a nice handbag at the dollar store for $1. Is that going to hold up as well as a Louis Vuitton? This lesson I learned the first year working. I bought dress shoes at Payless, and those things fell apart in like 5 months. It totally fell apart. It was almost like I couldn't believe how fast they deteriorated. And just one day they just exploded in my foot, and all the leather unlaced and all that. I had to walk home barefoot. That's because they were inexpensive and they were basically cheap. Then I bought a Rockport, and that thing lasted me like 3 years, and it was in very good condition. But it was a much more expensive shoe, 5 times the cost. So you get what you pay for. So if you buy a stock that has a high PE multiple, say like a Google, or some of these other software companies, you're getting a high quality stock, and people are willing to pay extra for it because it's high quality, it's likely to have better earnings and be a stronger player. If you have a weaker stock, a company that just not as competitive, not as bright of a future, then the PE is going to be lower. So it doesn't necessarily mean that you should buy low PE stocks, because sometimes those are just the crappy companies that people already know aren't great, so there's less demand for them, so the stock price is lower, which will make their earnings per share lower. But sometimes you get extremes. Sometimes they're overly punished and there really is good value there at the low end. And sometimes at the high end, they're overly loved and the stock prices are really way too high. When you have, Yelp at a PE of 100, that's a little crazy. But Yelp at a PE of 40 or 50, that's still expensive, but it might be worth it because there could be a lot of growth in this area. So this is what you have to, again, you see the ratio, but you have to think about the significance of it. Is it because you could have a high PE multiple that still can go up much higher. So this is a tricky part of it. They have looked at, take all the low PE stocks and put them together in a portfolio compared to all the high PE stocks. And generally, the low PE stocks do outperform when people have done studies on them. Because it tends to be that stocks that have on the low PE side get punished a lot more and their prices go a lot lower than they should. And on the high PE side, it seems the stocks get rewarded more and the stock price goes up a lot higher than it should be. And that's why sometimes we have this disparity. But if you look at those studies over longer periods of time, typically buying more quality stocks will return more to your portfolio over a 10-year perspective. So in a 1-year perspective, generally the low PE stocks do better, but in a multiple 10-year perspective, the quality stocks do better because they have more time to actually grow into their potential. That's why we don't say better or worse. We say more expensive, less expensive on this ratio. That's why we don't say the higher the better. Like in a lot of the ratios here, it just means more expensive, less expensive. So it really depends on what quality. Just like you could buy this $200 netbook here, or you could spend $1,000 on a MacBook, but there's a huge difference in quality. You're certainly getting what you pay for. Like the MacBook is, a phenomenal machine, totally worth it. This piece of crap is only good to bring to class because I don't really care about carrying it or dropping it or getting chalk all over it but I would never dare do that to my MacBook that sits in a shrine in a force field with plastic casing. I actually had a nightmare that I dropped my MacBook like 3 or 4 inches and the screen wasn't working right. That's how much I worry about it. I dream nightmares about what condition it's in. Half the time I only remember where this is. That's the beauty of it though. Sometimes when you buy less expensive, you don't have to worry about it. That's why I would never want to get a very expensive car because I would just worry all the time about it. You know what I'm saying? If you had to really, you sink $80,000 into a new Tesla, you have to worry about that car everywhere you go. But if you just get some used Civic for $5,000, who cares? Park it anywhere. Park it like this close to the car next to you in the student parking lot. You don't care. Curl out the window.
What about like non-name brand things? Like, I was like at CVS looking at Tums, and there's a CVS brand or like a Tums brand. Like, I bought the CVS brand. Am I going to get a lesser product because I didn't buy the Tums brand?
In some cases, yes. In some cases, no. In most cases, the same manufacturer. But we've all had this experience where we've gotten cornflakes and then we've gotten Pathmark cornflakes. And you open up the 2 boxes and obviously the bigger, fluffier, nicer flakes are in the cornflakes Kellogg's box. And then the flakes that were deemed not as good for Kellogg's, but they still didn't want to throw out, they made for second No Frills brand. So sometimes there can be difference. Just like paper towels, you notice there could be a quality difference. But there's also a prestige difference. Like, I used to tell this joke where before I have a date come over, I make sure I throw out all my No Frills products and buy all brand names for the refrigerator. So when they open it up, they're impressed with me. Like, oh, this person is pretty wealthy. They have all these brand names. They actually have Heinz ketchup and they have Ore-Ida onion rings, and because I think if you look at most people's refrigerators, we do buy a lot of it was interesting? One company actually spun that around into a positive. You take Trader Joe's, basically all their products are No Frills, but they package them as a premium product. So they contact all the manufacturers, Haagen-Dazs, all the cereal companies. They don't make anything themselves, but they contact all the major, and they said, listen, we want our own sort of off-brand Trader Joe's label, but don't give us the crap you'd give for a regular No Frills. Give us what your premium product is, and we're going to package it and sell it in our store. And since they don't have to pay for the advertising, that's what's the main price of all those cereal. Everything that has to be advertised on TV and have a mascot like Nestle Quick there, it's all you're paying. 30 to 40% of that product is advertising. With Trader Joe's, they don't have to pay the advertising, so they can make. That's why if you wonder why a lot of the prices are less, more affordable, but you're still getting a higher quality product. They actually got the mix right. They give you a high quality product in sort of a store brand package. But they
It's like the same. So it's the high-end stuff, but they just repackage it into Trader Joe's packaging.
right. So they went high end, but Trader Joe's brand name.
So it's
Where
all the same stuff.
it's pretty much the same stuff as, if you get their ice cream, it could be the same as whatever manufacturer. They don't not giving them purposely a lesser, which they do with some of like the canned vegetables and the cereals in like a supermarket. They'll actually, to make the price even lower, they'll go with the no frills, but they'll also go with accept lower quality standards on the product, and that can make the really low price point. But Trader Joe's said, we'll have everything in the store will be Trader Joe's for the most part, but we're going to go with quality. We're just cutting out the advertising costs. Um, so you can put a spin on it, and that's why a lot of supermarkets went away from the Pathmark brand. We had those cheesy store brands, and they try to make their own unique brand. Like if you go to Pathmark, they have like the American something, or they try to brand it so it doesn't look like a no frills. You know. At one time, they actually did call their brand No Frills, and they were in white boxes. And they did that for a while. It didn't work out for them. But America's Choice, that's what they have now. But we always could tell the worst is the sodas. When you go down and they try to copy the names. So instead of, Sprite or Mountain Dew, they'll do things like, or Dr. Pepper, they'll have Dr. Popper. And they'll have, instead of like Mountain Dew, they'll have like Splash It Up. It's really funny the names they come up with these sodas that seem similar. But in all the cases are made by the same bottler that makes the other sodas. They just don't have the advertising behind it. And of course, the earnings per share, EPS, is what's behind a big part of this calculation. Is the earnings per share, simply the earnings of the company divided by the amount of shares. And the PE ratio then again would be the stock price divided by the earnings per share. So there's sort of two ratios built into that. But earnings per share are important because if you remember from the simulation, if you buy back your stock, it's one way to increase your earnings per share without actually making more profits. Because if you shrink that share number at the bottom and you have the same amount of earnings, your earnings per share go up. And there are a lot of companies that they can't really move their earnings per share up as fast as they'd like just by increasing profits and sales. So what they do is they buy back stock to reduce the amount of outstanding shares so they can meet. It's one way they can meet their projected goals. So if they say we project $1 of earnings per share and they fall a little short on their production operational side, they can go and buy back stock to meet the goals. All right. So a PEG ratio is the first ratio here will really get closer to being able to buy a stock from it. And this is looking at the stock's PE ratio divided by its growth. And the idea here is that the stock's PE ratio should match its growth percentage. So if the growth rate in earnings is 20% and the PE is 20, that would be a PEG of 1, which we would say the stock price is in line and appropriate for its earnings growth. So that would be what we'd say a fairly average stock. A properly priced stock at a PEG of 1. Now, if the PEG ratio was greater than 1, the stock is probably fully valued or overvalued. And if the PEG ratio is less than 1, the stock would be considered undervalued. So if the growth rate is higher, take away the percentage. If the growth rate is 30%, take away the percentage. Let's say the growth rate is 30, and the PE is 10, that stock is undervalued, and it's going to have less than a 1 as a PEG ratio. So generally, companies that are growing, the PE should be as strong as the growth. So if you have a 25 PE of 25, you would want to expect a growth rate of 25. But this market, if you have a growth rate of 25, your PE is probably going to be, because this market's a little overvalued, could be your PE could be close to 40. So generally, this market, you don't see a lot of ones. I consider if the PEG ratio was 1, the stock would be undervalued in this market because we have sort of a bubbly type of market. And based on the volatility we had last week, which was usually people get nervous right before earnings season, and there's a lot of volatility. And then Friday, some good earnings came out, and the stock market roared back almost 300 points. Because if the good earnings roll out, people will forget about Ebola, they'll forget about ISIS, they'll forget about economic growth worries. As long as the companies are meeting their earnings targets or exceeding them, then they'll pour money back into stocks, because that is a much stronger influence than whatever people are interpreting about the world economy. And again, oil prices continue to go lower. So if you notice, now I see home heating oil under 275, and like last week it was like $3.05, and I saw gas at like 335 a gallon. So I'm projecting at some point this continues, gas should go below $3 a gallon. And the cheapest gas price I remember in my lifetime was 98 cents a gallon, and it was only for one weekend. It's the only time I remember breaking $1 since I've been driving. And that was during, we did have a couple periods where the growth of oil production outstripped the demand, and that's when oil can fall. I mean, there were points even in your lifetime in 2001, 2002, where oil was, $20 a barrel, very low. Or maybe that was more like 1999 or somewhere around that era. There was, and now with demand slowing and production increasing, we're seeing that the drop in the oil prices. Also, the strengthening dollar helps to make, when our dollar strengthens, since oil is priced in dollars, it sometimes helps to make the oil prices lower too. But that's good for the economy, and that's good for stocks, because it reduces energy costs, it reduces inflation, so it makes a more stable environment for businesses. Now, dividends per share, simply the dividends paid to common stockholders divided by the amount of money, total amount of money paid to common stockholders divided by the amount of outstanding shares. So it's pretty simple, the amount, taking the total dividend, say $10 million we're going to pay in dividends, and divide it out by the shareholders. It'd be sort of like if Microsoft says, let's take our $30 billion, or even Apple or whatever they have, 80 billion, I don't know. Let's take all that money and pay it out as dividends. If you want to know how much you're going to get, you just have to divide it by the amount of outstanding shares. So in Microsoft, maybe they have 4 billion outstanding shares and they want to give you $40 billion. That's a $10 dividend. That would really jump the stock price up, because people would be like, I want that dividend. The payout ratio is just looking at the dividends per share divided by the earnings per share. It just gives you a percentage. So if you have a $10 dividend on this is a payout ratio. So if you have a $1 dividend and a $5 earnings per share, you get a 20% payout. It's just looking at the percentage of earnings they're paying out to you. And they generally can't pay out more than 100%, because then they would be having to borrow money to pay you dividends, and that's not a good situation for a company. The book value per share, common stock equity, the amount of the company that shareholders own after they pay off their liabilities, divided by the amount of outstanding shares. And book value should always be less than stock price. So stock price is 50, book value should be less, maybe like 20 or even $10. It's always a dangerous sign to see the book value getting close to the stock price or being above the stock price, because that means the stock is very troubled, that they're basically saying the business is worth nothing. If the assets of the business are equal to the stock price, it's saying that basically the business is worth zero. The only value in this company is the assets that they hold. And there are some businesses where you could actually buy the business for less than the value of the assets and then sell the assets and make a profit. There are companies, equity companies, that look to do things like that. But that's why generally when that's the case, the stock price will rise as demand for the stock increases, because people see it's so undervalued. The book to price ratio, or price to book ratio, the stock price divided by the book value, giving us a percentage of the stock price and related to the book value per share. So if the stock price is 100 and the book value is 75, then the price to book will be what percentage? $100 stock price, $75 book value per share. If you have a calculator, now's the time to use it. 100 divided by 75. Right. So 1 1/3. So the higher this ratio, the more fully priced the stock is or overpriced, and the lower the ratio, the possible for undervalued. So it's really, again, just looking at the ratio. What's the stock price in relationship to the book value? If the stock price and the book value are equal, that means, and you get a price to book of 1, that means they're not putting any value on the business. The stock price equal to the asset, the equity, which is really take all the assets, sell them, settle all the liabilities, and the equity is what's left over. So if the equity is equal to the stock price, they're not putting any value on the business. Because the value of the business starts, just think like this. If you're going to look to buy a company and they tell you they have $100 million in cash, that's part of the company's bank account, you're not going to pay less than $100 million for that company. Unless they tell you they have $4 billion in debt, then you'd be like, well, that always has to come into the equation, their debt levels. Now, interpreting the financial ratios, there are many sources where you can get these financial ratios, but generally best calculated yourself, because you don't know how they calculate these ratios. At one point in time, are they calculated based on financial information from last year or this month? So you don't always get the most up-to-date or all the information when someone else calculates the ratios for you. Yes. I think that's isn't it a program that will give you the yeah, it's sort of like a CompuStat. They'll give you a program that does all the math for you and collects all the data and just it just outputs reports. So those things you have to pay for though. So and that's why institutional companies and investors generally will pay for subscriptions to those, also researchers to those types of databases. If you're an individual investor, it doesn't make sense to pay for that because they're so expensive. So you are left with either looking at different people's reports on these. That's why the free reports are generally not so up to date. So the only really way I would say is to calculate your own financial ratios. But here's a published report with financial statistics. Even Yahoo Finance, you click on key statistics, they'll have financial ratios in there as well. Not all of them, though. Some of the key ones. That's why they call it key statistics. Now, interpreting the financial ratios, the ratios can have what's called a trend analysis. And I have some handouts. We're going to look at some trends. You want to see how the ratios look in a time period, a period of time, and specifically looking for improvement. So you want to see that over the last 4 quarters or last 8 years or the last 16 quarters that ratios are moving in the right direction. Not sales are increasing, profits are increasing, return on assets and equity are increasing. You want to see that all the ratios are sort of constantly improving. Just sort of like if you started out as a freshman with a C average, and then every semester you've been working hard and you're starting to be a better student and you've been increasing your grade point average, that looks a lot better than if you start out with A's, like you're a freshman student with A's, all A average of 4.0, and then you get involved with drugs, rock and roll, and sex, and your grades start slipping. That graduate school looking over your transcripts would look at that and they'd want to know like what happened. They want to see people in an upward trajectory, not a downward trajectory. The same thing with stocks. We want to see stocks that are growing and that they have a good handle on there. So we want to interpret the trends, and we want to look at the ratios within an industry because you can't compare retail to defense and defense to software. I mean, every industry has their own specifics. Just like if you're going to be say you're going to be admitted to a graduate program, we'd look at somebody's grade point average from Yale quite differently than someone's grade point average from Hofstra. These are two very different schools. So some schools have inflated grade economies, or some schools are just known not to be as competitive. You wouldn't want to give someone with a 4.0 from like say an online school compared to someone who has a 2.8 from a Yale or a Harvard. So they're not. So you have to group them in industry. So you would group the students in the Ivy League schools, those would probably be comparable, and then maybe you'd have a separate industry for students from online schools. Um, all right. Evaluate. You want to look at the two or three most similar competitors that you could say would be, sort of, you would want to look at Coke compared to Pepsi, but not necessarily compared to Canada Dry. You would want to look at the two the, to evaluate which firm is better. So if you had maybe the car companies, you want to look at Toyota, GM, and Honda, sort of the closest in size and scope to each other to get a good comparison of who's really doing the best job on sales and profits and growth. Because some of the smaller companies, that it's easier for them to grow fast and have faster sales and profits. So it's not fair to compare a Tesla with a GM, a really small car company with a really big car company. And we were trying to figure out what the story is as far as the financial life of the company. Is it something that's a good story with a happy ending, or something that's a story that looks like there's going to be an unhappy ending? Like it's just the industry is just not going to go anywhere. It's going to be replaced. Sort of like if you look at Canon, they make the small cameras. But now with the cell phones escalating their camera abilities and their video recording abilities, do you really need to carry a cell phone like an iPhone 6 and a Canon camera if you go on vacation? No, because if the quality is so close now and the storage is so good on these phones, I don't need to carry two devices. So I want to carry less things when I'm on vacation. I generally always want to carry less stuff. It's no fun to have 6 devices with you. Your camera, your video recorder, your cell phone, your digital recorder, your computer. Now it can all be done on one big iPhone. So, and ultimately, you want to interpret these financial ratios to see whether or not there's intrinsic value at the company, which means whether or not this is going to make you money if you buy it. And there could be, a lot of times with these financial statements, they could point you to they could be the first to say there's problems. So inventories and receivables are one area where you can quickly see if there's problems in a company or heading for a problem. So if companies where inventory has an unusual buildup, that could be a problem. It could be there's no pull. No one's pulling that inventory. They're continuing to build or escalate their inventory build, but yet the retail side isn't pulling enough or isn't selling enough. So every time inventories build up, that could be a warning sign, especially in the auto industry, because you have to move that year, otherwise everything loses value. And same thing, receivables. If receivables are starting to grow quickly and they're not collecting their money, that's a bad sign for that company as well. Their customers are financially weaker, or they have bad collection practices, or something's happening there, or maybe they're aggressively trying to meet sales goals by more generously giving out loans to people that probably won't pay them back. See the whole mortgage industry of 2007, where they were giving mortgages. I remember a student told me they got a mortgage, they had no job, no money in the bank. I said, how the hell did you get a mortgage? Like, I don't know, they gave me one. I was like, okay. And now that would never happen today if you didn't have a job, and they wouldn't give you. But back then, to keep growing these mortgage brokers, to keep growing, they just kept lending to they don't care who they lend to as long as they can get it approved. Well, they tightened them quite a bit, so maybe they're loosening up now that it's really, there's a happy medium in the middle where that's where they want to get to. And I think a lot of places overreacted and over-tightened a lot of their mortgage requirements. And actually, Fannie Mae and Freddie Mac, they're supposed to be a little bit looser because they're supposed to be government supported and helping people who can't, afford a commercial bank mortgage. But the way they're really supposed to help is with lower interest rates. The same thing with student loans. During the Bush administration, they restructured student loans so that they'd be businesses and publicly stocks and private companies that make generous amounts of profits from students. and Obama reversed some of that. But still, I think it's criminal that they charge anything more than the rate of inflation for student loans. I mean, if the government's investing in you, and a lot of these loans are backed by the government. If they're investing in you to get a college education, they shouldn't be charging you 6-8% interest. They should be charging you, the same rate that they pay for their treasury bills. They shouldn't be making a profit on you, is what I'm saying. And the government makes, I think, like somewhere it was either 15 or 50 billion profits from student loans. And that's just, obscene. The government shouldn't be. They should be taking those profits and making student loans more affordable and more generous to get more people to go to school. And maybe more people would pay them back if they weren't so, aggressively, the interest rates weren't so aggressively high, because it would be easier for you, more of your loan payments would go back to paying principal, not interest. So if you are taking student loans, my advice to you is when you graduate to try to pay more than the minimum to get them down faster, All right. So that is chapter 7, and we discussed that over three classes. So it's a pretty big chapter. It's going to be well represented on the next exam. I have some handouts now that we're going to go over. So let me end this, and we're going to do some handouts.